Another rally on our hands to end the week. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming up, the global stock rally continues, a sixth consecutive day as another round of big-ticket AI deals and partnerships stokes fresh optimism.
Goldman CEO David Solomon adds to that optimism. He tells Bloomberg that the U.S. economy will accelerate next year as the tech spending picks up.
And the view from the Federal Reserve. Fed Governor Stephen Miran joins us live here in the studio at 731 Lexington Avenue as the government shutdown enters day 3.
A conversation you don't want to miss, again, to your point, happens in about 30 minutes time. But ahead of that, we do have some stocks on the move this morning, Matt. Applied Materials being one of them, down 2% in the pre-market trade. They're warning that U.S.-China trade restrictions will cost the company in the coming quarters. Specifically, they said it's going to lead to a $600 million hole in their fiscal 2026 revenue. Of course, Matt, they make the machines that make chips, hence why there's some restrictions on what they can sell to China.
All right, well, one company that doesn't have those restrictions is Tesla. They want to sell as much to China as they can. The shares are rebounding after actually closing down more than 5% yesterday. Remember, third quarter deliveries blew past estimates, but traders are concerned about future demand and perhaps the China concerns playing a role in that as well. Nonetheless, we have the shares back up more than 1% in the pre-market at 441. Danny?
Still, it is a day, another day, I should say. Every day feels like a day where there's some sort of AI deal happening. BlackRock's global infrastructure partner is in advanced talks to acquire Aligned data centers, which could be valued at $40 billion. Goldman Sachs CEO David Solomon says that these announcements are driving the U.S. economy.
Governments are spending enormously into economies in the developed world, and that keeps the economy going even when you have other headwinds. Second big macro phenomenon that's affecting the U.S. economy is all of the AI infrastructure build, all the capital spending, all that's going into the ground to support the deployment, the development, the continued growth of AI infrastructure into the enterprise, and that's a big tailwind too.
Jeff Bezos also weighed in on the AI spending. He says what's happening right now is an industrial bubble akin to the biotech bubble in the 1990s. He thinks it will ultimately pay off, and, quote, the benefit to society from AI are going to be gigantic. Joining us now is Bloomberg Tech co-host Ed Ludlow. I'm not sure if Bezos knows what a bubble is. If he says
also,
it's
isn't Jeff Bezos and Amazon like one of the biggest builders of all this stuff? I didn't really understand that. Sorry, keep going.
Well,
I was like, what?
I think his assumption is that Amazon's not a loser, but everyone else is. But there has been day after day.
I'll run some checks on that. I don't know, but you know, like the BlackRock GIP story is really important, and the specifics of it too. So they would acquire this entity with a $40 billion valuation. But look at the people that in parallel would take a stake, which is basically the same characters that keep coming up from the UAE. In this case, they've also already taken quite significant investment from Macquarie. What Aligned does is it does the building and location and management of the building of a data center. Like when I say the building, I mean literally the box, right? And the thing that we need to understand about this story is that there are all these forecasts. The one you might be familiar with is $4 trillion market, but that's just for the compute over the next sort of 4 or 5 years. If you include the concrete, the materials, the labor, the electricity supply, the cooling, the water, that's another $3 trillion. And this story is a clear example of Wall Street and legacy finance kind of moving to be ready for the non-compute part of the story.
I think Jeff Bezos does know what a bubble is. I'm looking at the stock right now from 1999 and the 95% drop into 2001.
Yeah.
Ouch.
I mean, he was there for the first internet bubble, right? He was a survivor. Amazon's definitely a survivor and a winner. But there was a circular spending problem then as well. You know, there was an overinvestment problem then as well. We paid way too much to lay fiber, which wasn't really utilized for the internet boom until years later.
Also, analogous, debt was a big part of that story with fiber. Debt's quite a big part of the story now with data center.
Right. So do you hear people drawing parallels to the 1999 internet bubble with this sort of AI build out?
Spoiler, my newsletter on Monday is about this, you know, and I think what's so interesting is that The only argument is that whether or not you believe top-line growth at software companies, the end customers of all of the AI development, justifies the initial investment or the debt levels. And there are loads that are sanguine about it and would say yes, yeah.
There's a lot of complications, though, in trying to figure out who the winners are. Also because just chip making in general, chip makers have done so well, but there still is exposure to the geopolitics. And Applied Materials underscored this last night. It's still a difficult environment to navigate who does well and who doesn't, and who's subject to policy and who's not.
So the story here, through a regulatory filing, is Applied Materials telling us that the Commerce Department and BIS has expanded the export restrictions, catching more of Applied Materials business, and it will have a $6 million impact to net revenue. When you manufacture a semiconductor in a clean room, all of these companies represent a different stage of the process. Applied Materials is right at the beginning with the wafer layer when you're trying to layer it up, and right at the end when you're polishing it. And then in between, you've got ASML, Lam Research, etc. The Commerce Department's argument is that if Applied Materials is able to go into China, then a SMIC or a domestic manufacturer fab will be more successful. So they want to restrict that technology. I would note that, like the downward pressure on the stock, Applied Materials has had a string of quite disappointing announcements that the street's getting a little bit fed up with. But I just think it's worth understanding, like, where Applied Materials sits in the process of building a chip. It's really core to it. And it's America's biggest chip equipment maker. So this is a policy thing. And the chances of the Commerce Department and BIS changing on that front, you know, who knows?
You don't have to wait until Monday, until his newsletter, to get more from Ed Ludlow. He is the co-host of Bloomberg Tech and will be anchoring one final show from here in New York before he gets into his first-class flight back to San Francisco. Now, large hedge funds are seeing their biggest gains in decades due to the global market rally. Bridgewater's flagship fund is on track for its biggest gain since 2010, up 26% in the first 9 months of the year, crushing the market. Bloomberg's Nishant Kumar covers hedge funds for us here at Bloomberg, joins us at the desk. You visiting from London, great to have you here. I'm so happy that we can talk about a hedge fund that's outperforming even the S&P 500, because normally we have to make all these caveats that that's not their benchmark, right?
Yeah.
But they're doubling it.
Let's still say that that's not the benchmark.
Yeah.
Of course, Bridgewater, as you said, is having its, or on track to have its best year in 10 years. But it's not only Bridgewater. If you look at our table, which is, of course, not comprehensive, and these are just the first look within the first 2 days of the month, you have macro fund, you have credit fund, you have a systematic fund, you have multi-strategy. So all
and a couple at the bottom who just bought SPYs, right?
Yeah, but all sorts of relevant strategies are firing up, right? So it's in hedge fund, it's never about hot and cold, market for these hedge funds. You go to hedge funds to avoid that temperature differential. It's not about getting burnt or freezing to death. You are looking for a perfect spring throughout the year.
But what has been working? Because you could make the argument that just buying and holding has also been an outstanding strategy this year, whether it be in credit, whether it be in stocks. So what are they doing to add extra alpha when beta already looks fantastic this year?
Yeah, so the bulk of the portfolio for an institution, you can go to beta, but this is about, what happens if the market crashes? What happens if 2008, which has been a very long time, and the history of markets will tell you that this time it has gone for too long, actually. So periodically it happens. What happens during those periods? That's why you buy hedge funds.
Well, and I mean, that will be the more interesting look, right? Seeing them outperform in a good year isn't as impressive as seeing them outperform in a crash. And it doesn't have to be 2008. It can be 2022.
Yeah, absolutely. We'll see. This year has not been easy. Yes, on a net basis, you can say, but there has been a lot of volatility. So you have to look these returns from that angle as well.
Got to justify the 2 and 20. Nishant, thank you so much.
Not only 2 and 20, now it's passed through, so it's well beyond 2 and 20.
Oh, boy. Well, you have even more justifying to do. Nishant, thank you so much for joining. Nishant Kumar visiting us from London. Now, the fallout from First Brand's Chapter 11 bankruptcy filing earlier this week is hitting Swiss banking. UBS faces over $500 million of exposure to the auto parts supplier through various investment strategies. For more, let's get to Bloomberg Finance editor Tom Metcalf, wrong Tom, in London. Tom, we have First Brands filing for bankruptcy, and the players are coming out as to who's exposed. What are we understanding about UBS's exposure?
Yeah, it's really interesting to run through this $500 million exposure. The real big headline there is effectively its hedge fund solutions unit, just going back to what Nishant was just talking about. They're not probably going to have the best quarter because they are sitting on about $233 million unsecured relating to basically supply chain financing they were given to First Brands. So that's the kind of standout for me. Also, the hedge fund unit, O'Connor, is also sitting on, I think it's about $133 million. That's been sold to Cantor Fitzgerald, but again, unsecured. So you'd expect, looking at the headlines, there's going to be some very heavy losses held by those people. And then you go down into the more secured stuff where, it's not quite clear how much will be got back. But for me, the interesting thing is UBS, kind of a bellwether wealth manager, finance manager, and you're expecting quite a few of their wealthy clients have probably been put into this, and they will, I imagine, not be too happy with their relationship managers. They
also, I believe, and correct me if I'm wrong, Tom, are one of the firms that's supplying the lifeline to First Brands. We're going to talk to another one later in the program. How much do they stand to recoup if that lifeline is successful and this company, although it's in Chapter 11, somehow comes back?
Yeah, it will come down to obviously how much they've secured. I think they're part of a group with about 1.1 billion, kind of in secured elements. So that'd be intriguing. And I think that's the thing. They're on all sides of this deal, which again just speaks to just how far these kind of private credit, these kind of off-market deals that they've sort of extended to now.
All right, Tom, thanks so much for joining us. Tom Metcalf joining us there out of London. In the next hour, by the way, we will speak with Sinjin Boran, portfolio manager at Beach Point Capital Management. Beach Point is another one of the lenders in that group providing a lifeline to First Brands. Coming up, Democrats are ignoring the White House's threats that they're going to make major cuts in government agencies and funds. We'll head to Washington after the break, talk about that. Plus, later this hour, a conversation you do not want to miss. Fed Governor Stephen Miran joins us live in the studio at 9:30 a.m. here in New York, right after the opening bell. This is Bloomberg Open Interest. It's getting out of high interest. Look at what's making headlines around the world. Apple is getting downgraded to sell at Jefferies, a rare bearish rating on Wall Street. The analyst says the stock price is already baking in a dreamy iPhone story and that the expectations have gotten ahead of reality. In essence, Apple will make a beautiful foldable phone, but how many people are really going to pay $2,000 for it? I assume that's a direct quote from the note. Boeing's flagship 777X jet is facing yet another delay. It's not as expected to fly commercially until 2027. That's at least a year later than planned, and analysts say it could trigger billions of dollars in accounting charges. The setback piles onto more than $11 billion in overruns for a jet seen as critical to Boeing's long-haul fight for flights with Airbus. And the Trump administration is escalating its shutdown tactics, freezing over $2 billion for Chicago transit projects. The White House budget director says the money for the city's rail lines is on hold, part of a broader push to cut federal spending and block what he called race-based contracting. It follows earlier suspensions of $18 billion for New York City and $8 billion for clean energy projects in Democratic states as the standoff over funding grinds into a third day. Earlier this week, Vice President J.D. Vance denied the moves are politically motivated.
We're not targeting federal agencies based on politics. We're targeting the people's government so that as much as possible of the essential services can continue to function. That is the question the president has asked the entire government.
And probably worth pointing out that President Trump put on Truth Social almost verbatim that he was looking at Democratic agencies to cut. So difference in language there. Let's get the details with Bloomberg editor John Harney in Washington. John, first just an update. Where do we stand? Does it seem like we are any closer to moving past the shutdown?
Well, in a word, no. The Senate plans votes this afternoon on both the House-approved so-called clean temporary funding measure and also a Democratic counterproposal that would address lapses in health care funding, and particularly the subsidies for people who want to get health or who get health insurance through the Affordable Care Act or Obamacare. Both these measures, however, are expected to fail, be defeated, and no votes are scheduled for over the weekend. So this is almost certain to drag on until next week. And the House, by the way, has been off this week.
I wonder about the reduction in federal workers. This was a campaign point for President Trump and something that, DOJ attempted to do with limited success. Why not, avoid the politics and don't bother making threats, but take advantage of this situation in order to really reduce federal headcount? Why doesn't President Trump, why doesn't Russ Vought go out and actually do that now rather than continuing to use it as a threat to Democrats?
Yes, and this threat and these ultimatums have only intensified the determination of both sides, Republicans and Democrats, and given them less room to maneuver. Because any sort of concession would be seen as a defeat. Now, as to your question, it's unclear at this point. I mean, there apparently is debate within the administration of just how sweeping any layoffs, dismissals could be or should be, and also the Doge campaign earlier this year was not terribly popular with voters. And, of course, the midterm elections are even closer now than they were, say, in January, February, and March.
All right. John, great to get your take. Really appreciate you joining us from Washington, D.C. John Harney there from Bloomberg Editorial. Now, while official government data is delayed, remember, it is Jobs Day, but we're not getting the non-farm payrolls report. Investors can see the labor market shifting, what looks like the labor market shifting into lower gear. A number of private sector indicators have in recent days pointed to sluggish hiring, limited layoffs, but sluggish hiring, modest pay gains, but easing demand for workers in September. Joining us now is Michael McKee, Bloomberg's international economics and policy correspondent. So, Mike, we're looking at ADP, we're looking at Challenger, because we're not getting any BLS data. And I guess what we see is not a lot of firing, but also not hiring.
Not a lot of hiring, although there's a very wide band around what's going on. If you look at the alternative data, we saw the Economist survey that Bloomberg conducts predict 53,000 jobs were created in the month for the report that we didn't get today. Revelio, they have a 60,000 gain. ADP, of course, had that negative 32,000 numbers. So we're all over the lot here. The Chicago Fed puts out an indicator that supposedly matches the unemployment rate. They suggested 4.3%, same thing as the Bloomberg forecast. And Matt, I know you'll join me in the promotion here. You can see all this data on WSL ALTE Go on the Bloomberg, a whole bunch of alternative data that you can parse and try to make your own guesses here. But you bring up a good point about being in the dark here, because we do have things to worry about going forward. One that could be even worse than not getting today's report. We could not get the CPI report on October 15th, and that would really put the Fed behind the eight ball in trying to figure out what to do at the end of the month. If we go long enough, the October jobs and CPI data collection could be imperiled. Can't go out and collect prices if there's nobody getting paid to go do that. And also, the government has a lot of contractors. They're not getting paid, so they may start some layoffs. And we have this threat hanging over us of Trump firing thousands more federal workers. So there's a lot going on in the labor market that we can't really track right now, which makes it hard to know what's going on. And we'll go Fed speaker by Fed speaker over the next couple of weeks to try to figure out what they're thinking about all of this. Setting you up there for another promo.
Yeah, I love that. And to Michael McKee's point, we will be speaking with Governor Miran in the next about 10 minutes. So stay with us for that, and Mike will join us for that conversation. But to your point, it's not just that the government, the administration is using this as a threat, an excuse to let people go. At the same time, they're freezing funding, $18 billion for infrastructure in New York, $2.1 billion in Chicago, $8 billion of clean energy for Democratic states. At what point, quickly, Mike, does this start to look like an actual fiscal drag?
Well, it could be a fiscal drag almost immediately if all of those jobs are paused and they stop work on them. The New York Times reported yesterday that the work on the tunnel between New Jersey and New York that is supposedly stopped hasn't stopped yet. So if that keeps going, it isn't going to be something you notice, and this could obviously be a negotiating point between the two sides, bring those things back if we bring the government back.
All right, Mike, thanks very much. You're going to obviously be with us here for the interview of Governor Miran. Bloomberg's Michael McKee, our policy and economics correspondent. Keep it right here because Federal Reserve Governor Stephen Miran will join our program right after the opening bells. This is Bloomberg.
Usually we'd be wishing you a happy jobs day in America, but an hour ago we did not get the data, and we will not because the government shut down. What does it matter? We're trading at all-time highs again. We hit the 30th record all-time high yesterday, but Matt, we just barely made it there with a gain of 0.06%. Futures look much like they did yesterday, a gain of less than 0.1%.
Yeah, we've been seeing record after record. Actually, this year we've hit a new record at least every 4 days, or that's the average,
Madness.
right? We have stretched valuations. We have a government shutdown.
Bezos says it's a bubble.
Yeah, there's a Barclays, and he knows a bubble. There's a Barclays index that says we're near exuberance. There's a Bloomberg index that says we're in manic mode. So
we're still buying.
But we're still buying. Less than 4 minutes to go until the opening bell. Remember, we're joined by Fed Governor Stephen Miran. After that, this is Bloomberg. Moments away from the start of trading, moments away from the start of another day on which we may get a record close for the S&P 500. This is Bloomberg Open Interest. I'm Matt Miller. We're only up 0.07%, but what did we close up yesterday? Just 0.06%.
Correct. So we're already doing better on that account.
Exactly. So NASDAQ futures up a little higher. Wow, look at the Russell futures up 0.5%. A lot of optimism for Fed rate cuts, and we're going to talk about that with Governor Miran in just a moment. You've got the National Cricket League ringing the bell at the New York Stock Exchange, and they're calm, cool, and relaxed. They're actually going to be there until Wednesday morning, just sipping Pimm's cups. Down at the NASDAQ, you've got Mount Logan ringing the bell, and they're a provider of insurance solutions that just had a combination, a business combination that allowed them to be publicly traded at the NASDAQ. So let's take a look at some stocks that trade here, and you're starting it out with AMAT.
Yeah, I am, because Applied Materials had a rough pre-market session, and it's looking to translate into a tough cash session. Shares are down nearly 2%. They warned that U.S.-China trade restrictions will be costing the company in coming quarters. They make the machines that make chips, and those chip curbs, they say, will lead to a $600 million hole in their fiscal 2026 revenue, Matt.
All right, Tesla shares are another stock we got our eye on today, rebounding after closing down yesterday more than 5%, which is interesting because yesterday, third quarter deliveries blew past estimates, I think 493,000, but traders are concerned about future demand. It's always about the future. Stocks are a discounting mechanism.
That is true, but they're buying the dip this morning, so at least there's that.
We are going to continue to follow all of the stock market stories for you as we do. Normally, 9 o'clock, we're focused on the markets. You know, surveillance is all about kind of the macro thing. You've got like 4 hours of interest rates and Fed coverage there, so you don't really need it from us.
Sure.
At 9 o'clock, because the market opens then, we cover single stock stories for the most part.
Yes, unless something is such an important conversation that it usurps all of that, Matt.
That's exactly what we're about to get into right this minute, and we're pretty excited about it here on Open Interest. We welcome our Bloomberg TV and radio audience worldwide. I'm Matt Miller alongside Danny Berger. Joining us now is Federal Reserve Governor Stephen Miran here at the desk. We're honored to have you here, along with Michael McKee, our international economics and policy correspondent. Mike, take it away.
Well, good morning, Steve. Thank you for joining us on this non-jobs day, we get no government primary economic data because of the shutdown right now. So let me start by asking, if that continues, as a member of the Open Market Committee, would you feel comfortable voting for a significant cut in interest rates if you don't have data on employment and on inflation?
Good morning, and thanks for having me. Look, I think it's important to recognize, first of all, that as you're pointing out, access to high-quality data is of utmost importance when making monetary policy decisions. However, it's also the case that we don't make monetary policy decisions every day. Right? The FOMC meets to vote once every 6 weeks or so. Now, I think that's a bit longer than most shutdowns have historically lasted, so I'm hopeful that we'll get the data by the time we actually have to make the decision.
Well, despite what the president says, as you well know, inflation is rising. Food prices are up, gasoline prices higher than when he took office. Those are the prices that Americans notice and hate. So isn't it a risk to cut rates significantly in a regime where inflation is rising?
So my view is that policy should be forward-looking, right? I don't necessarily have a forecast that those items are going to continue rising. In fact, I think that a lot of them will actually reverse somewhat. But for my process, what matters most of all is the cost of housing, because that is the single largest component of the inflation process. And it's also one of the things that people notice the most. They notice when their rent surges. They notice when the cost of shelter increases. And that's why it gets the largest weight in the inflation indices. And my expectation is that we've just experienced, the biggest population shocks to both the upside and the downside in my lifetime, and I think in most people's lifetimes. And to me, it would be very surprising if that left no lingering trace on the price of shelter. And so I am expecting a significant disinflation to the services component of the inflation indices driven by shelter, which is affected to an extent by changes in population growth.
Well, we were talking before we came on about your view of R-star, the neutral rate. We've got inflation running at basically 3%. You've got unemployment at 4.3%, which is historically very low. The Atlanta Fed says we're growing 3.8% or grew 3.8% in the third quarter. There's no economic model that I know of that would get you to a near zero neutral rate with those kind of conditions.
Yeah, so first of all, I have seen some folks argue that they think that my conception of the neutral rate is zero. That's not the case. I think that's a misreading of the speech. If you read the speech carefully, you'll notice that I do a weighted average of a model implied ex ante and a market implied ex ante rate, and it comes to about a half. And that's consistent with the dot that I put down on the statement, on the summary of economic projections. And so I basically thought, sort of going into things last year, there were all these policies that were pushing R-star higher, like the highest population growth we'd seen in decades, the largest sustainable fiscal deficits we'd seen, sustained fiscal deficits we'd seen in a really long time. Those are pushing R-star higher. So last year, I really thought it was at the top of the range of where everyone else on the committee thought it was, and I think it's now come down this year to the bottom end of the range of where everyone else thinks it is.
But you can't model that.
What do you mean I can't model
that? The models, if you put in the numbers that we have right now, it wouldn't spit out near zero or 0.5%.
Oh, real rate. Well, no, but what I've done is modeled my expectations for inflation based on the changes that I see happening from housing, as we talked about a moment ago. I've modeled out changes to the output gap that I expect to see from policies that expand the supply side of the economy and therefore expand potential output faster than they would expand actual output. And some policies that we've seen enacted over the course of this year would push out potential and actual by the same amount or bring in potential and actual by the same amount. Other policies would push out one more than the other. And so for an example of one that would push out one more than the other would be deregulation, right? I think that the regulatory state has been being peeled back over the course of this year, and all indications are that will accelerate, particularly as the pace of confirmations of appointees has just picked up as well. That, in my mind, will accelerate the pace of deregulation, too. And when you remove regulations, you expand the potential output of the economy faster than actual output. And so that creates a positive output gap.
I actually, I'm not as deep into this as Mike, and certainly neither of us is as deep into it as you, but I have the Taylor rule function on my Bloomberg terminal. I love to play with it, and I always ask important economists when they come on what variables they would plug into it. I put in 0.5 for you in the neutral rate here, and I put in 4% in the NAIRU. I'm still only getting 3.5 for the Taylor rule estimate. I know this is a very elementary, function here on the Bloomberg, but what would you change to get your rate down to where you think it should be, which is even, I think, less than the 3% terminal rate that the market is pricing in.
Yeah, so let me be clear. Monetary policy works with lags, right? And yes, those lags are long and variable, but nevertheless they exist. And so I think it's inappropriate to put in the current backward-looking data as opposed to where you expect those data to be in the near term, right, over the course of the next year to 2 years or so. And so that's why when I work through the calculations that I worked through in the speech, which also used actually a couple of different specifications of the Taylor rule, I put in my expectations for where I think inflation is going to be. I put in my expectations for where I think the output gap is going to be. And so when you look at inflation now on a year-over-year basis, you're including lots of stuff that occurred before the overall policy space shifted. And as I just said a moment ago, we just lived through the largest population growth shocks on both the upside and the downside in very rapid succession to a variable, the structure of the economy, population growth that usually changes only very, very slowly, changed incredibly rapidly in both directions, right? To use backward-looking data that just ignores that shock on the upside and the downside, which was of monumental historical significance to the U.S. economy, I think is deeply misguided. I think it's imperative to use forward-looking forecasts that incorporate something like that.
Well, we can do that with the Taylor rule on the Bloomberg terminal. As I'm sure you know, if you click on the second tab of the function, you can put in your inflation forecast and your unemployment forecast going forward. I won't ask you what all of your variables were, but I will ask about inflation because as a kid who grew up under Ronald Reagan, I've always been skeptical of government policy when it comes to inflation. I've been hearing for so many years that the Fed wants to get it to 2%, but I find it hard to believe, and we've averaged 3% essentially on the core since World War II. Do you think most people feel comfortable with that level, with a 3% level?
Well, I think what you're asking sort of invites a previous question, which is what did Congress assign the Fed to do? And Congress assigned the Fed to pursue stable prices. Now, historically, the Fed has had lots of leeway in how to interpret that, and it's chosen to interpret that as 2% growth in measured personal consumption expenditure inflation, right? The way that you calculate inflation is sort of, it's a very complex thing, and there's lots of methodological choices that get made when you're sort of deciding how the sausage gets made, and it can really affect how things are measured, right? And so when you say, do households have faith that the Fed is pursuing and achieving its inflation mandate? I think that, sort of small changes in measured inflation are difficult for households to detect because they can be, because the way that measured inflation is measured is there's lots of noise in it. And I think that small changes in measured inflation are usually dominated by the noise relative to what households are experiencing. But nevertheless, when you look at inflation expectations, I think that they remain reasonably well anchored, which indicates that households and firms in the United States have faith in the Fed's ability and willingness and future of hitting its inflation target.
Governor Miran, you've been extremely transparent with your view and have been very generous with that. You've always been very transparent with your views. You're probably the most prolific social media poster of anyone that the Fed's ever had. In 2023, I saw you had tweeted something out saying basically the case against adjustment cuts is that financial conditions have eased massively and policy works via financial conditions. Real rates don't exist in a vacuum. Given that view, the fact we have record high stock prices right now, is it a sign of unsustainable froth, of even a bubble that will make bringing down inflation that much more difficult?
Yeah, so that's a great point. Financial conditions are the channel through which monetary policy works, and so they matter when you're thinking about where monetary policy should be set. Now, as we were saying a moment ago, my view is that last year neutral was much higher because immigration was much higher, because fiscal deficits were much higher than I expect them to be going forward. If you look at fiscal deficits this year, in February through August, which are the data that we have available, and that encompass after the policy space changed, they're about $400 billion at an annualized rate below where they were in the comparable period in the previous fiscal year, right? So fiscal deficits are coming in also, and that also helps drive down our STAR. So my view is that policy, even though financial conditions appear to be on some measures loose, policy has actually grown tighter because neutral has migrated down. Now, I do want to be clear that financial conditions can also be driven by a variety of non-monetary factors. There have been substantial changes to the supply side of the economy this year, both through the tax code and through the regulatory code, as well as trade renegotiation, right? All of that can affect financial conditions for non-monetary purposes, through non-monetary channels. And so it can be a little bit of a mistake to look at financial conditions and infer something necessarily about the stance of monetary policy, because they can be driven up by other things. And also, they're not all loose. I mean, housing finance is arguably still a relatively tight
channel. Sure, but a lot of this view is incredibly forward-looking, and that's the point, right? That we're not looking at backward data. But is there any data that we could get, Governor Miran, that would change your mind, and would change your mind to have you believe that we should not be pushing towards more rate cuts right now?
Oh, absolutely. Look, my view is that services inflation is the most persistent and sticky part of inflation. A lot of my view about services inflation is driven by the housing sector, as shelter costs are the largest cost for most families. My view about shelter inflation, as I said, is driven by two things, as I said in the speech. One, the fact that average rents have finally caught up to market rents, meaning the catch-up period is done. People don't reset their leases every day. They reset every year, every couple of years. And so that means that a change in market rents takes time to feed through to when it's experienced by households. When you look at the data, it seems to me that catch-up period is done, which means that I expect shelter rents to come down, CPI rents to come down, bringing shelter inflation down. The second thing is the immigration shock that we talked about. My view is that immigration was pushing rents up in previous years, and now that shock has not only gone to zero, I think it's actually reversed. I think we have negative net migration when it comes to the United States this year, right? So my view is driven by two things. Services are the more persistent and sticky part of inflation. Services are driven in large part by housing, and I expect housing inflation to come down through those channels. If something were to happen that were to tell me that channel is invalidated, that there's some shock that's going to be pushing rents materially higher, the benign inflation forecast that I have would have to be adjusted as a result. All else equal, right? If nothing else were to change to offset that. But to me, that's the core of my inflation view. And I would want to see something come along and tell me that channel is wrong and that I'm thinking about it the wrong way.
I want to ask you about something in your speech that has confused a lot of people, including me. You argue that tax cuts are going to help lower the deficit by increasing economic activity. And at the same time, you argue that tariffs, which are taxes on the American people, are going to lower the deficit. You have one way raising taxes and the other cutting taxes at the same time lowering the deficit. How does that work?
Yeah, so it's important when you think about economics to think about the elasticities of supply and demand. And when you cut taxes on American production, whether that's labor or whether it's corporate income, you want to think about the elasticities of supply of those activity. And is it going to lead to additional labor supply? Is it going to lead to additional investment, right? And so that's the way that cutting taxes can actually generate economic growth in the United States. When you think about tariffs, again, you think about the elasticities of demand and supply. And in this case, American consumers and firms are the demand, and foreign producers are the supply. Now, the economic evidence is overwhelmingly that the elasticity of the demand in imports is much higher than the elasticity of the supply. Put another way, foreign producers are inelastic, right? You've got a factory in China or somewhere else, and it's stuck in China or wherever it is. It's installed capital. It's inelastic. Whereas American importers can alter their demand patterns. They could import from China, but they also could import from Vietnam, or they could make stuff at home. That flexibility gives them the ability to avoid the burden of the tariff. Now, this is just tax incidence theory in public finance, economics 101. And when you look at it this way, the argument that economists always reach, the conclusion that economists always reach, is that the burden of a tax, a tariff, a subsidy, anything, falls on the more inelastic party, right? Now, the evidence is overwhelmingly that the foreign producers are the more inelastic party because the factory is stuck in place, it can't move, whereas import demand can substitute across borders. So, it is the case that the negative effects of any tariff fall on the more inelastic party, which is overwhelmingly the exporter and not the importer. And so as a result, the positive effects of tax cuts in the United States get felt by production and they increase economic growth, whereas the negative effects of raising revenue from tariffs get borne by the exporting country.
Well, we haven't seen any evidence in import prices that that's happening.
Well, import prices, as you're pointing, dollar-denominated import prices, as you're pointing out, have been relatively flat. However, people, I think you're alluding to an argument that people make, which is that you would see import prices decline if foreigners were reducing their selling prices. That's the argument you're referring to? Yeah. to me, that logic doesn't follow for two reasons. One, there's an implicit all else equal clause that's not being stated, and all else is not equal because we also had a move down in the dollar this year, which ought to increase import prices by a comparable amount. And so the fact that import prices look relatively flat could just be the increase in import prices from the weaker dollar just offsetting the decrease in dollar prices from the incidence of the tariff being borne by the exporter. The other reason why it doesn't really make sense to me is because I think that a lot of the importers of record are ultimately U.S. subsidiaries of foreign companies, and so you've got a Japanese or German exporter selling to the United States, but the exports are bought by U.S. subsidiary of them. So Mitsubishi Japan or whoever is selling to Mitsubishi U.S. or whoever, right? And then if this is the case, then what winds up happening is that the incidence ends up falling on the importer of record without necessarily pushing a decline down in import prices. And so I'm not exactly sure on the magnitude of this channel yet. It's something that I'm looking into, but it is a possible disruptor of that argument. But in any case, for sure what we're seeing is not a broad-based increase in consumer inflation as a result of tariffs.
Governor, I want to ask about a piece that Mark Summerlin wrote in the Wall Street Journal today. He, previously of the NEC, under the Bush administration, basically says that the Fed suffers from the same kind of bias inherent in media or academia because it's so focused in the Northeast, right? We have 4 Fed banks between Richmond and Boston and only 1 west of Kansas, right? Only 2 in the South. He says there should be a Fed bank in Miami and Phoenix, which would make sense. He also points out that of the $600,000 donated by Fed staffers in the 2024 election cycle, 92% went to Democratic candidates. I assume that's because they're in the Northeast and they're underpaid relative to Wall Street. So can you make reforms, especially on those 2 issues, while you're at the Fed?
Well, look, reforms to the Federal Reserve, to the structure of the Federal Reserve, are ultimately an issue for Congress to take up and not one for me to address. But I do see part of my job as bringing fresh and out of consensus ideas to what can be, at times a settled way of thinking. And that's what I'm going to continue doing. And so, for example, you think about tariffs and whether they're causing inflation or not. I think there's an attitude among a lot of people, which is that the correct counterfactual for thinking about tariffs is to compare them to pre-trends for what was the trend in those goods before the pandemic. Right? To me, that's the wrong counterfactual because there was so much else different about the structure of the economy when you look at long-term trends before the pandemic. They include, you look at 20-year trends before the pandemic, which is what a lot of people do. It includes the entry of China into the WTO and shipping deflation to the entire world. Is that the correct counterfactual for thinking about the impact of tariffs on the economy today? If we're not experiencing the same deflation we experienced in 2004 in goods when China had just entered the WTO, and then attributing all excess inflation relative to that pre-trend to tariffs, I think that's the wrong counterfactual. For me, in my mind, the right counterfactual is non-import goods. And that's why the way that I've looked at it is to compare the prices of import-intensive core goods to overall core goods. And I would think that if tariffs are driving inflation, import-intensive core goods would inflate at a materially higher rate than overall core goods, and that is just not the case. That is not what you see in the data. That's the study that I did when I was the CEA chairman, and I asked the Fed staff to replicate it, and they found that when you use this counterfactual, you get the same outcome, right? So the question is, what's the choice of the counterfactual? And that drives the decision, that drives the inference for me. The other counterfactual that I think is appropriate to use is to say, are core goods in the United States inflating at a faster rate, at a noticeably faster rate, or markedly different trend than core goods in other countries? And again, when I run that experiment, I see no discernible substantial difference that would make me think that core goods inflation in the United States had broken away from core goods inflation globally. And so for me, I think that there's a question of how do you think about these things? And I think everyone was thinking about it one way, and I think about it a different way. And I view my job as bringing in new and interesting ideas to try and get people to think about things in different ways.
Can you do that when the ideological heart of the Fed is in New York? It's at Harvard University. It's in the Democratic Party. How do you move it away?
Well, I am also of New York and of Harvard University.
I get that.
And have no trouble saying my view, even when it's wildly out of consensus. And speaking my mind. As long as I believe what I'm saying, I have no problem sort of speaking my mind. and getting my thoughts out there.
Well, Governor Miran, it's not only the rest of the FOMC you have to convince. You have to convince these markets as well, especially if you are concerned about housing. You were very outspoken last year when the Fed was cutting and long-term rates were going higher. If that were to happen again, would you be a proponent, especially as you see one of the Fed goals should be for moderate long-term rates, that the Fed should be using the balance sheet in order to keep long-term rates lower?
So, two things there. One, last year I was an opponent of the Federal Reserve cutting rates because I thought that neutral was higher and that therefore the Fed was not as restrictive as they thought that they were. And therefore I viewed the accommodation being provided as inappropriate. And I think, as you're pointing out, that long yields moving higher meant that I was actually kind of right. I think that bears that out. This time, thus far, and it's still early days, the meeting was, 3 weeks ago. It's still early days, but, thus far we haven't seen that type of increase in long yields that we saw last year.
What if it were to happen, though?
Well,
should the Fed be using its balance sheet?
If it were to happen, the first thing I would want to do is ask why, right? Why is it happening? And if I came to the conclusion that it was happening because it was inappropriate to cut rates, because my inflation analysis was wrong, or my analysis of neutral or the output gap was wrong, then the first thing to do is probably to reverse course on the front rate. My view is probably not to sort of resort to balance sheet at the first opportunity. That balance sheet is the tool that you use when your more standard tools can't work for the problem at hand.
A couple of lightning round questions here as we're getting a little short on time. Do you think that if you'd taken a sort of less extreme position, not come in arguing for 150 basis points or so of cuts, that you might have more influence on your peers on the Open Market Committee?
I don't think my position is as extreme as you make it sound. My dots for next year and the year after are not so dissimilar from the rest of the committee. All that's different is the fact that I want to get there a little bit faster. I think that most people on the Fed, sort of they operate with in your Taylor rule application, you probably have an inertial parameter, right, where there's a sluggish adjustment. So wherever policy should be set, you sort of phase it in slowly from where you are. So if you're wildly off from where you are now, there would still be a very slow adjustment to where policy should be set. And I think that that's the type of thing that some people sort of default have in their mind, right? That's not my view. My view is that if policy is out of whack, you should adjust at a reasonably brisk pace. In part because if you stay restrictive for too long, you really run the risk of bringing an output gap materially wider that you don't want. And in my mind, we're not at that point yet because policy just became more restrictive because monetary policy just became more restrictive because R-star just moved down. Right? We're not at the point yet where if you sort of keep it there another day, it's a crisis. But if you keep it there for an extra year, yeah, I think you have problems on your hands.
Given the import that the president has attached to the Fed, as a member of the Board of Governors of the Federal Reserve, do you feel like you exercise executive authority?
No, I don't exercise executive authority whatsoever.
Have you talked with the president or anybody at the White House since you came to the Fed?
Well, as I said, I think a week ago, 2 weeks ago, I don't remember. Time runs together for me these days. The president called me after I was sworn in to congratulate me, and that was very generous of him to sort of say congratulations. And he has never asked me to sort of to take a specific policy action. He shares his views about where monetary policy should be, but he shares that with the world.
Have you talked to him since that congratulatory call?
No.
One very quick question. Have you had your interview for Fed chair yet?
No, I have not. And personnel decisions are not decisions that I make.
All right. Hey, thank you so much for coming in. It's been a fantastic interview. Really appreciate you being so forthright. Federal Reserve Governor Stephen Miran, as well as Bloomberg's Michael McKee, our policy and economics correspondent. I will add to our terminal clients that we do have an adjustment for policy inertia in the Taylor rule function. You can see it on the terminal typing TAYL go. Danny, we have a lot coming up in the next hour.
We do indeed. In the next hour, as Matt's alluding to, BlackRock's Rieder will be joining us, as well as Beach Point Capital's Sinjin Boron and Snap-On CEO Nick Pinchuk and Julie Coronado, a former Fed economist.
Inertia. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Danny Berger. We are up 0.25% on the S&P 500, so headed for a 31st record high on this market.
Oh, and it looks like we have breaking economic data. Thank goodness. We still have Michael McKee with us here on set. We're getting, ISM services, because we got the manufacturing yesterday, and it looks like we're missing the mark in terms of the headline number, Mike.
Yeah, the headline number comes in at 50, which is right on the line between contraction and expansion, and it is lower than what was anticipated. We were looking for a 51.7, and so we dropped from 52 to 50 even. Prices paid goes up a little bit. It is a very small amount to 69.4 from 69.2, which is why it took me a second for that to register. New orders fall to 50.4 from 56, and the employment index is 47.2, which is up a little bit from 46.5 back in August, but really insignificant in terms of what it means overall. And that'll be interesting to see if and when we do get the payrolls report, what happens with service industry jobs, because that's what Stephen Miran was talking about, service industry inflation. It is the biggest part of the economy, so we'll see what we get out of that. Business activity does fall to 49.9, below 50 from 55. So things have slowed down, and the outlook has slowed down for the service industries.
You get a little bit of a market reaction. Stocks ever so slightly weaker. You also see yields come in. They were pushing much higher, but now your 2-year yield up by just 1 basis point, 2 basis points for the 10-year yield. So they have come in, but not massively. Mike, thank you so much for all of your excellent work this morning and for that fantastic interview with Governor Miran. That's Michael McKee. And we did speak with Fed Governor Stephen Miran earlier, just moments ago. And Mike asked him about today's delayed payrolls report.
Access to high-quality data is of utmost importance when making monetary policy decisions. However, it's also the case that we don't make monetary policy decisions every day, right? The FOMC meets to vote once every 6 weeks or so. Now, I think that's a bit longer than most shutdowns have historically lasted, so I'm hopeful that we'll get the data by the time we actually have to make the decision.
Well, we certainly did not get it today. Let's continue the conversation with Rick Rieder, Chief Investment Officer of Global Fixed Income at BlackRock. Rick, fantastic to see you this morning. And it's not just the Fed that needs to make decisions without data. It's this market. As we exist in this black hole and try to parse through alternative data sets, how much conviction can you have on fixed income and where yields go during this government shutdown?
So listen, by the way, I've said it for a long time. One of the ways we actually get really good data is corporate data. Like I've found, I think survey data is interesting. I tend to think it's skewed. It tends to move with sentiment, tends to move, quite frankly, I always find with the S&P 500 moves a lot of these surveys. What I focus on, and what I more so, obviously we need to get the data. We need to get the payroll data. That is good data generally. What we need to get, what I think is fascinating, and particularly in today's world, is you look at some of the corporate numbers and you look at what's happening with hiring, what's happening with productivity, how are they managing inventories. Listen, more data is better. We do loads of things with AI now and look at how you scrape the internet, how you look at credit card data. So anyway, this is one of the pieces you'd like to have, but you certainly don't feel like you're operating in a vacancy.
I mean, I was just talking with Mike McKee about this during the break, and I don't know how much granular data you need to know that core CPI is going to be about 3%, right? It seems to hang out there forever and everybody's fine with it. So what are the most important pieces you're looking for? Is it on the labor market as opposed to on the inflation side?
Matt, I mean, it's such a funny thing. I've been doing this for a really long time. I'm always blown away that we sit around, and particularly in my business, we sit around and wait for that CPI report, and it's a couple hundreds of a percent that seem to shift sentiment one way on inflation. At the end of the day, it's actually not that big a deal. To your point, we're operating price stability. It's actually at a pretty extraordinary level. We're ticking up a little bit because of tariff transmission. That is a big deal, and obviously in the short term, but our sense is that's going to come down, a la productivity, et cetera. To me, it is for the next 5 years, the most critical piece of information is going to be labor. I do think that productivity, innovation, technology, you think of the amount of money that's going into it, will ultimately bring down wage pressure and will bring down, consequently, will bring down inflation. Labor, to me, is a big deal. Think about what's happened the last few months. you're actually watching the economy. We print, 3.8% real GDP. The economy, we think for the year is going to print over 5%, 5-ish% nominal GDP. Companies are printing tremendous earnings reports, but they don't need the same amount of infrastructure. Labor, you look at what's happening to SG&A, cost of goods sold, labor, much productivity is happening. It's not like AI is 2 years from now. Productivity, not just AI, inventory management, logistics, how you run your business more efficiently. And by the way, part of what's playing out is companies gaining scale. They're trying to get scale because you think about how you can run your business, higher margins, lower cost infrastructure. Long-winded way of saying, we need to keep more people employed in this country, and I think the primary trend or the primary focus has got to be let's keep full employment where it is, for however we get there.
Still, how we implement AI, Rick, is in the early innings. Many companies are still just figuring that out, and in the meantime, until that's fully figured out, billions is getting plowed into the project of this. You see Jeff Bezos, even though Amazon has put a lot of money into it, saying that it is a bubble, and yes, it will have benefits, but it is a bubble. So what happens in the meantime? Because there is this timing mismatch, perhaps, of the productivity gains, of that helping inflation. What happens in the meantime before we get that, and we still have this massive spending that maybe looks a little bubbly?
So I would say there are two parts of that. The first one is, I always like debating and wondering where the efficacy of AI is going forward is very hard to consider today and think about where we're going to be. What you do know, and as an investor, I always think you've got to parse your investment paradigm into what are the buckets and what is the time frame that we're operating within. For the next 6 months, the next year, next probably 2 years, the amount of money being spent on infrastructure to develop this, as an investor, that to me, that is critically important. I need to know how much is going in, who's going to create cash flow off of it, who's going to grow top-line revenue off of it. So I would say in the near term, those numbers are real. And when I look at the cash flow and the free cash flow, some of these big hyperscalers, and by the way, it's not just around AI, cloud, software development, logistics. We talked about robotics, automation, and I just think what's playing out in front of our eyes is it's not just AI, and it's easy to bucket things into one. Automation, productivity, robotics, software, efficiencies in how you run your company. Like all of those are leading to more efficient businesses, which, like I say, I think creates a labor problem going forward, potentially a labor. By the way, part of why I think one of the developments, if we move the mortgage rate down in this country, if you build more houses, like the benefits of doing that, because you put people to work hard to AI building houses. And what it does, it creates velocity of labor. And when you create velocity, so if somebody loses their job in one city, they move 2 cities away, but they got to sell their house, or 2 states away, they've got to sell their house. So all these things become very much interlinked.
How much does that affect BINC, Rick? BINC, this is the ETF that you run, the iShares Flexible Income ETF. I noticed some allocations in there, for example, to high-yield corporate debt. But how much is that related to, and the rate of return that you get in this fund to the AI boom?
Yes, sir. So, listen, one man's opinion. I've said this before. I think this is the golden age of fixed income, the golden age of getting yield. I don't know, and I don't think anybody really knows 2 years, 3 years hence, what it means in terms of, you could go through some crazy studies of how the costs of things come down radically, and I've heard some pretty brilliant people talk about that. Today, versus the prior 2 decades, if you can get 6.25 yield, think about, to your point, Matt, if inflation, let's say it's 3. If you can get 6.25, and you're at 3, like that is unbelievable. So what we're trying to do, keep our yield there, keep your yield there, but keep your volatility down. Think about how pensions, endowments, foundations, their return target is usually about 7. If we can keep our yield at 6.25, keep our volatility running about under 300 basis points of volatility, so that people can buy equities, do other things, private credit, et cetera. For us, it's like keep it at 6.25, keep it well into investment grade, and diversify it like crazy. That's been a big deal for us. Keep that. So we've had to rotate. As yields have come down generally, a little bit of EM, local rates in EM, if the dollar is softer or contained, EM is interesting. A little bit more fixed income in Europe because of the cross currency gets back to the currency. So we've been tweaking that, but the whole, our laser focus, keep the yield up, keep the volatility down, keep our quality at a good level.
And that helps you with these big trends, be it AI and, Rick, really the other trend. It's a conversation that I find myself continuing to have is the Passover of net worth, that the boomer generation has this huge amount of wealth. And this is a chart you've been looking at, the percent of age 70 plus total household net worth. It's now at 31.7%, the largest by far on record. What does that do to this market, Rick?
So yeah, and thank you for showing that chart. What we're living through, I hear analysis all the time that compares today's rate structure or the paradigm today, the economic paradigm, to the 60s, 70s, and 80s. Completely different demographic, completely different manufacturing versus services. What's happening today that is extraordinary, and then you get to the interest rate tool. Older savers have no debt. They actually are sitting on piles of cash and liquid assets. So what happens is when the interest rate stays high, they actually have more income. They have more income. When you break down the consumption that's happening in the country today, the vast majority is wealthy, older savers. The part of, like, if you bring the rate down, actually, when people say, oh my God, if you bring the rate down, you'll create, economic boom. Well, actually, the consumption is being driven by older savers, higher income. So the number that I think is staggering, if you take 40% of the country, the lower 40%, of wealth, they account for 22% of consumption. The top 10% account for 23% of consumption, meaning I hear people talk about economy's doing great. The economy's doing great because a cohort of the economy is getting more income, and the more we keep the interest rate up, they get more income. It's the people that borrow, that are homeowners or want to take out a HELOC, that are struggling. And you see that every earnings report, you see that, including the airlines. First class doing well, main cabin not so much. It's a pervasive trend.
And Rick, and by the way, I'll make an assumption here, which I probably shouldn't do, but I imagine that the wealthiest people in the country are also able to live the longest. And the reason that share of 70-plus people holding so much net worth is so high is that we're just living longer and longer and longer and able to extend that.
Yes, sir. By the way, that chart, not to simplify that chart into its older, it is savers. And there's a demographic evolution. By the way, we didn't get a payroll report, but so what's driving payroll and what's been driving it for years? Healthcare. So think about the jobs report. What we would have got today. Let's say it was 60,000 jobs. It would have been all healthcare, roughly. We don't know what it was, but at the last 4 months, if you stripped out healthcare, the job creation is negative. So aging demographic, like you said, plus a paradigm of where the savings is and who owns the debt, or who owns the assets versus who has debt on their books. But by the way, it's completely different than anything we've ever seen before, and that's why I find these traditional analogies just don't make sense. The economy don't make sense.
It is absolutely fascinating. The silver tsunami. Rick, thanks so much for joining us. Rick Rieder there from BlackRock. Let's get a check on what's going on in the markets right now, because we are in position to put in place another record on the S&P 500 right now, up 0.25% after just eking out a gain yesterday. As we've been talking about, this year we've averaged a new record high every 4 days. And right now we're looking at 6 days in a row of gains on the benchmark index.
Is it counterintuitive that 10-year yields are up 2 basis points, despite the fact we just had U.S. services falling to the weakest business activity since 2020, but who said markets make sense these days? Here's a move that probably makes sense. Applied Materials down 3%. They've warned that U.S.-China trade restrictions will cost the company a $600 million hole in their revenue in 2026, Matt.
Tesla shares rebounding today after a drop yesterday. They dropped yesterday on good news that they had amazing deliveries, and they were back up today. Although, look, they've fallen again, so no rebound.
Volatility. Shares of Apple, they are falling. Jeffries downgraded the iPhone maker to an underperform, a very rare bearish rating. The analyst said that the current valuation prices in an overly bullish iPhone outlook. I'm pleased to say that we will be speaking to Jeffries' Edison Lee later this hour, the man behind that call. But first, coming up, Sinjin Boron of Beach Point Capital Management on signs of fragility or maybe continued strength in private credit. We're going to discuss the push and pull. That's coming up next on Bloomberg Open Interest.
Goldman Sachs CEO David Solomon is optimistic about the U.S. economy. He spoke with Bloomberg's Tom McKenzie at Italian Tech Week in Turin on his outlook.
The U.S. economy is in pretty good shape, and there are some very, very strong tailwinds that have really had a profound effect, and there are also some things going on that are creating headwinds and are probably leading the economy to underperform its expectation at this time, but I'm optimistic that we're probably going to see an acceleration as we continue to head into 2026. The big structural issue that's kept the U.S. economy going so well is the U.S., and by the way, other developed economies around the world, are running very aggressive fiscal stimulus plays. Governments are spending enormously into economies in the developed world, and that keeps the economy going even when you have other headwinds. Second big macro phenomenon that's affecting the U.S. economy is all of the AI infrastructure build, all the capital spending, all that's going into the ground to support the deployment, the development, the continued growth of AI infrastructure into the enterprise, and that's a big tailwind too. That's balanced on the other side by the implementation of the trade policies, which are still getting absorbed. I think we're seeing some of the effects from trade, but there's still more to go in terms of really understanding how the trade policy is fully implemented and how it balances growth. And then obviously the world's a little bit more geopolitically fragile, and that has an impact on growth and kind of confidence. But when you balance it all, you saw the third quarter reading was quite strong, but year over year, from last December to this December, the overall growth trajectory will probably be a little bit less than 2%. And so that's slightly below trend, but still in pretty good shape.
And an acceleration into 2026?
I think that as the trade policies are absorbed and you have the continued stimulus and the continued kind of tech spend, you've got a pretty good tailwind. I hear as I talk to CEOs that would kind of have their finger on the pulse. Certainly the upper end of the economy is still spending quite strongly, a little bit more constraint on the downside, on the lower part of the economy. But I think the things you have to watch labor. There's no question labor is a little bit softer, and the Fed's watching labor carefully. And, I think you've also got to watch inflation and whether or not the impact of trade is just a one-time price movement or there's something, more significant that comes through, and it's too early to know.
That was Goldman Sachs CEO David Solomon speaking with Bloomberg about his outlook for the economy. Let's turn to credit now. And legendary short seller Jim Chanos is sounding the alarm on the private debt boom following the collapse of First Brands, the auto lender, telling the Financial Times, quote, "I suspect we're going to see more of these things like First Brands and others when the cycle ultimately reverses, particularly as private credit put another layer between the actual lenders and borrowers." Joining us now, I'm thrilled to say, is Sinjin Bohran, portfolio manager at Beach Point Capital Management, who is one of the lenders stepping in to give First Brands a lifeline. Sinjin, wonderful to see you this morning. And I think we should be clear in this that Chanos has been a credit bear his entire life and calls the end of things many, many times. But here he is arguing that First Brands argues more collapses to come. Do you think he's right?
Well, hi, Danny. Thank you for having me this morning. I would say, first of all, I can't really comment on specific credit situations, especially ones that are ongoing. What I can comment on is just broad trends and how they might feed into the overall leveraged credit universe. And from that perspective, we don't disagree that ultimately this business cycle will turn and that we will probably get higher defaults into the end of the cycle. We just don't think that right now is that time. Credit fundamentals, while slowly eroding, are still quite strong. The technicals that are underpinning all of the subsectors within leveraged credit, high yield, senior loans, private credit, those are all still quite strong as well.
How much of it, though, is just the amount of money sloshing out there, the demand for credit in all corners of the universe versus the fundamentals?
Right. It's a great question. I mean, it's one reason why valuations are where they are. And to us, what recent events are more indicative of, they really play into this theme of dispersion within the market. There's a huge amount of leveraged credit that trades at very rich valuations. And then in the other end of the spectrum of the market, you start to see problems arise, and it can also be overlaid very neatly with the type of buyers within each of these subsectors. And that's what speaks to the amount of capital flowing into each one that you described.
Well, there was a study from Fitch saying that in a monitor of roughly 1,200 corporate borrowers or private credit, they reported a default rate of 5.5% in the second quarter. That's higher than the first quarter, which was 4.5%, which maybe speaks to your point that it is a split screen or a dispersion of the haves and have-nots. St. John, is there a risk, though, that on the downside, on the defaults, that it could spill more broadly, that it could create pain in other parts of the market that were otherwise healthy, as you maybe contend with things like forced sellers or otherwise?
Yes, it's a very good question, and I mean, it really does come down to the fundamentals themselves. I mean, so this type of market really should emphasize the need, importance, and even criticality of doing bottom-up fundamental credit analysis on each position within a portfolio. Right now, most of the default activity has been very idiosyncratic in nature. We have seen a recalibration of risk premia in certain subsectors. Consumer financials comes to mind. But to us, that's just the market being conservative. It's not really a reflection of any sort of panic at this point.
We've been hearing for a while now, St. John, that there's so much liquidity and there's so much demand for fixed income products that spreads are going to stay this tight near to eternity. How much easier or how much more difficult does that make your job?
Well, it's both, right? I mean, the yield on these sub-asset classes is incredibly attractive. And so we do focus on that. From a spread perspective, I think some time series of quality composition needs to be taken into account when we look at how spreads have changed over time. High yield, for example, is of the highest quality that it's been in decades. And so that probably warrants tighter spreads in general. Additionally, some of the components that go into spreads, including liquidity premium, forward expectations of credit losses, all of these are quite benign at the moment. And so we would expect that this current framework for the market would continue.
St. John, there has been a trend post-financial crisis, fueled after COVID, when the bank stepped out of the market, that more lending was going towards private credit. We did, though, see last week $55 billion, the biggest LBO, where JP Morgan financed $20 billion of that, was the sole financer. Does that maybe suggest that things are shifting back the other way and that banks in the broadly syndicate market is coming back and taking market share back from private credit?
Mm-hmm. In part, yes, but also the size of that particular transaction sort of speaks to the necessity of having deep pools of capital and multiple asset classes that they can tap in order to finance it. And so that share shift is likely to go back and forth, as the market progresses. I can't think of a better example of just market dispersion in general than having that size of LBO announced during the same month that loan payment defaults increases for the first time, in over 2 years. And so again, just harkening back to that theme, especially as financial conditions ease, as rates come down, we would expect more of that. But that doesn't mean that private credit is out of the game in terms of financing some of these transactions going forward. We would expect 2026 to be an incredibly busy year from that perspective.
St. John, really appreciate you joining us. St. John Boron there of Beach Point Capital Management. This is Bloomberg.
Hand movement there.
Breaking news from Bloomberg Tech's Ed Ludlow. He is reporting that Rivian is reworking its doors after employees and customers raised concerns over potential safety issues with the current design. Ed joins us now. And Ed, this doesn't mean that they're necessarily going to change the current design, the R1.
Right.
They're just thinking about a new door handle for the R2, which isn't out yet.
Correct. What we're talking about and what you need to know is that in the R2, which is their next-gen vehicle going into production at some point in the first half of next year, there's been a rethink on the manual latch or release that a passenger in the front or rear seats would need to use in the event that the electric system loses power. And what sources told us is that on their existing vehicles that are already out there in the marketplace called the R1, as part of a redesign, a generation-to-generation redesign that went through, the manual release, again, it's something you use when the system loses power, usually in an accident. Its position was moved to a sort of more inaccessible area of the rear doors. And what we discovered in the course of reporting, partly through anonymous complaints through NHTSA's database, is that people had a hard time with this, right? There was also an acknowledgement from Rivian staff internally that on that existing generation of vehicle, it's a potential safety risk. It's not intuitive in the event of an emergency to find this cable release that is somewhere inside the rear door covered. And so that's the reporting. Rivian, for a vehicle that's not yet out, is making a design change. We are not saying that Rivian is subject to any investigation, and we're not aware of, nor has Rivian disclosed any sort of accident, fatal otherwise, involving the door. But I do know internally a lot of the engineering teams and other executives realized that the design change they made in R1 when they updated it was a mistake. And this is the reporting we've done with Bloomberg's Emily Chang. What happens next, we just don't know.
And it also comes off the back of concerns about Tesla, excellent reporting that the team has done there about locations of their manual safety release too. How widespread is this in the industry among EVs?
Yeah, so the reason that EVs in particular with electronic door systems are now in the spotlight is that they are designed with intent. The benefit of having an electronic latch is that if you are traveling at road speeds and somebody in the rear seat, it's like a child, tries to open the door, the system recognizes the car's moving and so stops you. In other words, you can't open the door by accident. In old-fashioned cars, Matt, as you know, you could open the door with a manual release if you want to, even if traveling at speed. The issue is that the design has to take into account the electronics that power the window, the seals of the vehicle, and it all has to fit in the form factor of an EV that's a much more narrow space. And so the problem is that they have to put a cable release somewhere. And the story with Tesla that's analogous, you're right, is that there have been fatal incidents in Tesla's case where both incapacitated and other passengers just couldn't make it work. And the emergency services struggled to get them out of the vehicle from the other side as well.
I mean, part of the problem is they're using technology to fix a problem that doesn't really exist. I mean, all you do is put a manual door release and make it a little bit too difficult for a child to open, right? And I guess that's probably like a nanny state culture problem, as well as like we want to design things as high tech as possible. Hannah Elliott, my co-host on our podcast, Bloomberg Hot Pursuit, which you can download on Spotify or Apple Podcasts or wherever you listen, has a story out when car tech goes too far. Audi and Mercedes learn to pivot because they've got these newfangled gadgets that nobody really wants, and they only put them in for the sake of tech.
Well, real quick, our understanding from sources is the fix for the R2 is quite simple. Just make the manual release easier to find, make it the same design as the front seats and the rear seats, rather than having one system for the front, one system for the back, and make it more intuitive. Right. The point being that Rivian internally realized, the way we did redesign it for the R1 wasn't intuitive, it was more difficult to find. It's just an engineering and technology story, as you say.
Well, Lucid does it, you pull the latch a little bit and it's electronic. If you panic and pull it hard, then it becomes manual. And Franz von Holzhausen from Tesla told us that's what they're going to do essentially as well with a button that you push. At first, it's electronic. If you push it hard, it becomes a mechanical release. So what a fascinating story. Ed, congratulations to you and to Emily Chang. Ed comes on in just 30 minutes' time. He's the co-host of Bloomberg Tech at 11 with Carolyn Hyde. Now, unfortunately, we did not get payrolls data this morning due to the government shutdown. You can find alternatives to the data we've been telling you on the terminal. Just type WSL space ALTE, or you can talk to someone who has boots on the ground across the country to get a read. And let's talk to somebody like that right now. Nicolas Pinchuk is the chairman and CEO of Snap-on. And Nick, if I recall correctly, you are constantly going around and visiting shops, visiting auto mechanics, visiting auto body professionals, and talking to them about the industry, about the economy. What's your read right now on the U.S. labor market?
Okay, here's what I'll tell you. Hey, good to see you again, Matt. You know, I hope you made the Fish concert in Columbus this summer.
It was a tough ticket.
I'll tell you that. Hey, look, Look, yeah, I was just in Washington and Maryland and D.C. the other day talking to franchisees and speaking to them. You know, in our war, the economy is pretty good, but the labor market has a whole bunch of different implications associated that aren't necessarily indicative of the economy. I was at the National Association of Manufacturers, a great organization, over 10,000 manufacturers in part of that. And what's happening in manufacturing today, which is a big driver of employment, is people are keeping their powder dry. Because they're looking out in the future and say, I got to restructure the supply chain. And while it may seem that tariffs have settled down, we haven't done trade deals with Canada, Mexico, or China. And they are the principal sourcing partners for manufacturers. So all these manufacturers are sitting there, they're like quarterbacks who can't diagnose the defense. They're saying, I don't want to throw an interception, so I'm not going to commit to anything right now. I'll keep my powder dry, not really stay pretty lean, because I know when I make a change, it's going to raise costs. So I want to get some benefit or some cushion against that. And so that's what you're seeing. We're hiring in our hand tool plants, and we're a little different. Snap-on makes 80% of what we sell off the vans we make right here. But there are other companies that are doing that. They're sitting
Nick,
back and saying,
to take your football metaphor.
Danny, welcome back from London.
Thank you very much, Nick. Very kind of you. Great to be back. But if I could take your football metaphor and probably torture it and butcher it a little bit, a quarterback not moving is a decision in itself, and it's a quarterback that will get sacked. So if it is companies and manufacturers that are deciding not to do anything, to sit on their hands, at what point does that become a problem in itself for this economy?
Great analogy. Great analogy.
You,
it's a question, though, of the timing. In the NFL, it's 2.5 seconds. But if you're talking about making a decision and moving on a factory, this is one of the interesting, it's much different than the street's expectation. You know, I remember April 2nd, the Liberation Day, everybody expected manufacturers to have made a decision. It doesn't happen that way. You can't redeploy physical assets as fast as you can redeploy financial assets. And I think that creates a mismatch in terms of expected timing. So what happens when you move a factory, Danny, is you have to figure out what you're going to do with the people at the other end. You have to figure out how to bring it down. You got to make sure that your documentation is right, because if it isn't, you're going to spit up blood all over the move. Many people have lost a lot of money in moving factories. And you have to figure out your new site. You have to get the workers. All those things take time. And so, yes, the analogy is correct, but you have a lot more time than I think the financial community realizes in that situation. One of the things that's happening today, I think, boy, there's a lot of uncertainty. The costs are going to drift up if you have to move to the United States. Eventually, they'll go down because the American worker is so effective at driving down costs. But you want to keep yourself as lean as possible. It gives you more degrees of freedom for whatever you're going to do.
Nick, I want to ask about your business because, as you know, I'm a fan. Whenever I see a Snap-on van, I try and stop and buy a tool. I can't afford a whole kit myself because I'm just tinkering in my garage. But I was thinking about the president's new obsession with furniture, woodworking, cabinetry, and so on. And looking through your website, and I saw everything related to mechanics, aerospace, tooling, etc., but nothing to do with woodworking. Why doesn't Snap-on venture into that sort of area?
Well, we actually don't venture too much into factories. Some woodworking could be the case, but Snap-on actually prospers where the penalty for failure is high and the need for repeatability and reliability justifies the Snap-on level product. I mean, these are non-Perel products. And so that's one of the things that defines our place. Now, a woodworking guy can probably afford to have 2 or 3 implements. But when you're in repair, Matt, as you know, the mechanic addresses the car. He doesn't know what he's going to use. He can't afford to have many of them because he's not going to use the same tool over and over. He needs to have a full array, and they got to work right away. This is a Snap-on thing. One of the cool things about Snap-on is I think it demonstrates the power of the American worker. One of the things about the labor, I think, secretly in this kind of thing is they think, well, manufacturers are never going to resource because American workers can't compete. You know, I know there are people, when I say this, they're thinking I'm a disciple of Jethro Tull. I'm living in the past. Well, that's not true. The Snap-on proves it every day that we can compete. Our margins have gone from 6%, and then going up 85% a year for the last 15 years. We're at 22% today. I'd like to say it was charismatic leadership, but everybody here knows it wasn't. What it is the American worker enabled. We enhance them by training. We enable them with technology. There are no deliveries from evil in technology. We don't expect AI to deliver us from evil. We expect it to help us gradually and enable our workers. Then they figure out how to improve because they're the best people to know how to improve their site. They know the job, but they know where it should go. Then we celebrate it and we start again. This is what's driven it. And so this is the core of the American worker. They do it better than anybody else. So we reshore, we'll engage more of our people in technical careers and be stronger than ever.
Nick, I think we can also say it's thanks to a very charismatic leader. We love having you on. Please come join us again. Snap-on Chairman and CEO Nick Pinchuk. Coming up on the show, a rare bearish rating on Apple. Jeffries downgrades the stock, citing excessive iPhone hopes. We're going to talk to the analyst Edison Lee behind the call. That's coming up next. You're watching Bloomberg TV. One stock we are watching this hour is Apple. Jeffries downgrades the iPhone maker to underperform, a rare bearish rating. The analyst saying that current valuation prices in a, quote, overly bullish iPhone outlook. Edison Lee is that analyst of Jeffries, joins us now. Edison, great to see you. Thank you so much for joining. I know it is very late in Hong Kong where you are, so we appreciate it. 60 analysts rate this stock. You are one of 4 to give it an underperform or a sell rating. Why?
I think that generally the smartphone industry is a very mature industry. And I think that unless there are some groundbreaking innovative features, a lot of consumers may not want to upgrade. And I think that the growth of the used smartphone market is also putting pressure on the brand new smartphone market. Because, for example, if you're using an iPhone 13, you don't have to buy an iPhone 17. You can buy a used iPhone 16 or a used iPhone 15 that are in pristine condition, and they probably would work for another 4 years. And the functions are still very similar. And we know that the used smartphone market is growing at double digit, and it's already reaching over 300 million units a year. So I think that's a structural headwind for the smartphone market. I know that AI presents a very big hope for growth. But I think that it's actually quite challenging for any smartphone makers to figure out actually what consumers want on AI and how AI can actually differentiate from each other, and so that consumers are willing to buy a new phone quickly. I know that iPhone 17 reception seems to be pretty good. I don't disagree with that right now, but I think that whether it's sustainable going into the next 2 months remains to be seen. And also the market seems to be very excited about the foldable iPhone that will come next year. And I think that the optimism about a foldable phone, I think, may be a little bit premature, because if the selling price is at $2,000 or even more, then I think the TAM is somewhat limited. If you look at some of the similar high-end foldable smartphones in the market right now, for example, Samsung put out one that is very nice, very thin, thinner than the iPhone 17 Air, selling at $2,000. The expected one is no more than $3 million right now. So that's why I think it's difficult to expect.
Edison, this is fascinating to me, because essentially what you're saying, and correct me if I'm wrong, is that Apple doesn't really face a competition for the iPhone from Huawei necessarily, or Samsung. It faces the most competition for the iPhone from previous generations of the iPhone. That's the problem, is that you don't think people are going to necessarily upgrade to the latest when they can get almost the latest, because they do the same stuff.
Exactly. I think that's an industry-wide problem. So that's why it's not about people who don't switch from Android to Apple anymore. A lot of the Apple or iPhone's demand is actually coming from older iPhone users who need to upgrade. And if you look at the smartphone market globally, I think 75% of demand is coming from developed markets. And developed market consumers, they in fact all have phones already. And that's why the decision to whether they will buy a new phone depends on whether there are new functions that their current phone cannot do.
Hey, Edison, literally less than a minute here, but you also talk about the fact that they're not raising the prices. Would it have made a difference to you if they did, if they put out a more expensive iPhone?
Well, I think that it's a difficult issue to deal with, right? Because number one, if you raise the price, then you will you will be worried that it's going to impact purchasing power, and that's why your volume. But I think that Apple certainly makes this conscious decision to keep the prices the same. And in fact, the selling prices of iPhone have been unchanged for 3 years already. And in fact, this year, the base model effectively has a cut because they are selling a higher memory version at the same price as a lower memory version that they sold last year. And they stopped selling that low memory version anymore. So that's why I think they're trying to use the base model to try to gain back some market share and try to accelerate migration. And I think this probably is the reason why the reception is actually pretty good.
Edison, great to get your take. Hope we can get you back on the show as soon as possible. Edison Lee there of Jefferies on his re-rating of Apple stock. Coming up, Julia Coronado joins us from Macro Policy Perspectives. She's going to tell us why she thinks a recession over the next 12 months is more likely than not. This is Bloomberg Open Interest.
I don't think my position is as extreme as you make it sound. My dots for next year and the year after are not so dissimilar from the rest of the committee. All that's different is the fact that I want to get there a little bit faster.
That was Fed Governor Stephen Miran speaking with us earlier on his outlook for the U.S. economy. Let's get more with Julia Coronado, a former Fed economist who now runs Macro Policy Perspectives. And Julia, what do you think of the idea that we really need to cut rates quickly in order to support this economy going forward?
Well, I think that that's sort of simplifying the problem that the Fed is facing, which is that there are very real risks to both sides of their mandate. We have been running above their 2% target for more than 4 years now. That is something that's a real threat to longer-term credibility of the central bank. And what is a central bank if it's not credible? So it's not something to be taken lightly. And, most of the committee and most forecasters still think the full effect of the tariffs lies ahead, not behind us. Meanwhile, we look at the labor market, and it does look pretty squishy. Now, the big challenge here is disentangling what is a structural slowdown because of restrictive immigration and what is a cyclical slowdown due to weakening demand. And it's honestly looks like a mixture of both. The unemployment rate hasn't risen very much. And right now you could put most of it, the bulk of the slowing in hiring, into the bucket of structural, though the broadening of reduced hiring, which is resulting in negative net hiring. There aren't a lot of layoffs, not a rising unemployment rate. So I think that Governor Miran is simplifying the problem that the FOMC is facing, and they're doing their best to kind of square the circle and make sensible policy in the midst of these conflicting risks.
Julia, usually on a day like today, the first Friday of the month, we'd have fresh economic and jobs data to ask you about. But because of a government shutdown, we don't. Typically, history tells us that government shutdowns can come and go without too much impact. Is this time different, though? Neil Dutta has been writing that it comes at an especially fragile time, and government workers who have been put on furlough might, in whole, change their spending behaviors. So it could have an outsized impact this time. Do you think he's right?
I agree that we are at a point of fragility. And so the economy seems to have kind of ground down to a low run rate. And so the risks are inherently higher of any kind of a shock. I think it really depends, too, on how much, we're hearing lots of blustery, strong threats. Very unusual, right? We don't usually see the federal government, our leaders, threatening to use this as an excuse to cut programs and lay off workers. I think that's mostly a negotiating tactic, but they have engaged in very significant layoffs. They haven't all gone through yet, and that's another problem. We've got probably a couple 100,000 federal workers who've already been laid off, who know they're going to be losing their jobs but are still being paid for now. So sort of government shutdown or no government shutdown, we're about to feel the real shock of a loss of government jobs over the next few months.
And in your view, a potential recession, right, Julia? We've only got 30 seconds, but why?
Yeah, no, I think it's the labor market. We are at a tipping point, feels very tippy. And meanwhile, we're just throwing massive fistfuls of sand into the gears of the U.S. economy with policy. So the risks look tilted in that direction to me.
Hey, Julia, thank you so much for joining. Julia Coronado of Macro Policy Perspectives. Maybe sand in the gear, Matt, but another day where we're headed towards record highs, not just for the S&P, but for the equal weighted as well. It's a broad-based rally this morning.
Yeah. By the way, there's a lot of sand where she is, right? She's in Texas. And I'm going to call her up after because I want to ask what she thinks about the Wall Street Journal piece. Should they move more Fed banks down to the Southwest? Coming up on Monday, Marta Norton joins us from Empower, as well as Raquel Oden of HSBC.